And we're live.
Okay, thank you. So good afternoon, everyone. We are at the Spending Affordability Committee for Howard County again. Today we actually are going to go over a pretty exciting agenda. Look on the screen there. The first item is we're very pleased to have a financial advisor joining us today, talk about credit rating. We have been, as a committee, have been heard and discussed about credit rating a lot of times there. And today we have our expert joining us here. Their thoughts about the credit rating and also kind of assessment of the county's financial health in general. And then after that, Rafael, our finance director, and the team from finance will be presenting on the county's debt affordability, different indicators, and how we're doing on the debt management. And following that, we will present from budget office the fiscal outlook and also multi-year projections, at least a preliminary version. And joining me will be my deputy director, Brooke, and we can answer questions if there are any. At the end of the meeting, then I will talk a little bit about the next steps there, because starting from next meeting, Steve pointed our vice committee chair will be taking over and then focus on coordinating the discussion of recommendations and to put together the report from the committee to be delivered to county executive. So we have a full agenda today. I think, Jen, let me stop sharing and you can test and see whether you can share screen from your end. And thank you very much for joining us. We really look forward to your presentation.
Not a problem. Can everyone see the presentation up on my screen?
Yes. Yeah,
Perfect.
This is great.
Yep. Great. Well, thank you, Dr. Sun. I appreciate you inviting me here today. I just wanted to do a quick introduction. My name is Jennifer Dierksen. I am a senior vice president at Davenport & Company. We are the county's financial advisor. I've been with Davenport since 2016. And we provide financial advisory services to the majority of Maryland counties, but I work primarily in the Mid-Atlantic with a Maryland focus, including Howard County. And prior to that, I actually worked at Moody's Investor Service as a credit rating analyst and covered the state of Maryland as well as the county there as well. And I did that for about 6.5 years. So very excited to be here today to talk about credit ratings and just the overall financial health of the county. So just to give you an overview of credit ratings, a credit rating is really a measure of a government's willingness and ability to pay its debt on time and in full. And investors use these ratings to decide whether or not they want to purchase the government's bonds. So the higher the assigned rating, the less risk of default that comes with buying those bonds. And here on this slide on the right-hand side, I have included a chart that is a rating scale. These are all of the investment grade ratings. And you can see the top rating is AAA, and positively, the Howard County holds AAA ratings from all 3 national rating agencies. So that includes Moody's Investor Service, S&P Global Ratings, as well as Fitch Ratings. And the county is actually only one of 55 counties across the nation, so the top 1.7% that hold this distinguished designation of having a AAA from all 3 national rating agencies. And if you take that down a little bit further, that Howard County is they're one of 10 counties that hold this AAA designation. And I've listed all of the other Maryland counties that hold this designation here on the slide. And one thing that the rating agencies do as they look at a credit is that they use peer comparisons. It's a really important tool that they utilize. So Howard County specifically would be measured against both national AAAs as well as AAAs in Maryland, and typically Virginia as well, because Virginia is a very similar state in that your counties are responsible for education, which is not always the case in some of the other states across the U.S. But you will see that, with a high number of AAA ratings, including Howard County, this is really just a lot of times due to the strong economies that we see here, wealth levels, as well as strong financial positions, manageable debt burdens, and proactive management teams. And so those are really sort of the main drivers that support the AAA ratings. In terms of the rating agency criteria, the rating agencies are always looking at their rating methodologies, which is what they utilize to determine a rating. It outlines, the metrics and the approach that they have to take and things that they need to look at to determine a rating. Moody's just recently released a new methodology at the end of November 2022. They changed their metrics slightly, which we'll talk about in a little bit. And S&P and Fitch are actually currently going through an update now. They have proposed methodologies out for comment or have been out for comment. And so that's something that we're closely watching as we move forward. While there are slightly different approaches that each rating agency takes to get to a credit rating, they're generally focused on four major rating factors. The first being the economy. So they're really looking at, tax-based growth. What is that trend? What are expectations? Also, is the tax base diversified? What kind of industries are located in a particular place, and they want to make sure that there's no concentration, because that obviously brings risk if you have one major employer or taxpayer. So that's something that they're taking a look at, which the county does not have. And then they're looking at the demographic profile, including wealth levels, and just comparing those across the state and nation. The second factor is finances. This is looking at reserves and liquidity, both a historical trend as well as future projections. They want to see that local governments, including the county, have adopted reserve policies, and that the local government is following the reserve policies that they are adopted. In addition, they're looking at reserves, as I mentioned, to other AAA rated counties in Maryland and across the nation. And I would say the reserves are actually the single most important rating metric that a credit analyst looks at. When I worked at Moody's, that was the first thing that I looked at when I opened, an audit, and that's the first point of discussion typically in a rating committee. So that is a primary focus of the rating analysts. The third factor that they look at is management. This is really just looking at the strength of the management team. Are there formalized financial policies, conservative budgeting assumptions, long-term financial and capital plans, and also structurally balanced budgets. Those are the type of things that they're looking at when they're thinking about management. And then finally, debt and other long-term liabilities. And this they've expanded on. It used to be focused on just debt and pensions. Recently, Moody's added in OPEB as a formal factor, and in S&P and Fitch's upcoming or proposed methodologies, they are also looking to add OPEB as well. But really just trying to get a sense here of the overall leverage between debt and long-term liabilities, and seeing if it's manageable or if it is going to cause any future financial pressure. And so while, the county is rated AAA by all three agencies, is important to, remain strong and comparable to peers and all of these factors to ensure that the AAA is maintained going forward. So here is just a little overview of the rating reports from 2023. Overall, the rating reports were extremely positive, and so we've just pulled some snippets from each of the rating reports. Fitch in particular expected strong revenue growth due to strong economic activity and continued investment in the county. They noted the county has high fundamental financial flexibility. You have the ability to raise property taxes. There's no cap on the property taxes. And aside from education, the county also has the ability to make spending cuts as well. The county's liability, they noted, is very low, and they look at the projected needs, debt needs, as manageable. Moody's really noted the strong resident income, which we'll talk about in a little bit, and then also continued benefits from the growing economy with the institutional presence. Obviously, you benefit from the proximity of Fort Meade. You also have APL here as well. So there's a lot of institutions that are sort of provide grounding here. Healthy reserves, which are generated through strong management. You continuously budget conservatively with it, which is positive, and you've been able to grow your fund balance, which we'll talk about. S&P, they noted your strong economy, management, budgetary flexibility, liquidity, and institutional framework. Institutional framework is really taking a look at your ability to raise revenues and reduce expenditures under a legal framework. And then they also noted your strong budgetary performance and then adequate debt and contingent liability with an overall low debt burden. So overall, very positive from the rating agencies from the last reports. One thing is that while they noted most of these strengths, there was one thing that all the agencies had in common, is that one point of potential rating pressure is that while reserves have increased, if they were to decline in the future, that this could lead to negative credit pressure. And it was noted in all three. S&P also noted that the reserve levels need to be commensurate with AAA rated, and if they fall to be more of in line with lower rated peers, that's something that they're going to take into account when looking at the rating and doing their review. So now I'm just going to go through some peer comparisons that I pulled in each of these different factors: economy, finances, and then debt and other long-term liabilities. There's no real hard, peer comparisons for management, but happy to answer any questions about that if there are any. But in terms of tax base, a local government's tax base is really the source from which revenues are generated. So the larger the tax base, the greater the ability to generate revenues to support, the county's operations. So you'll see here, I've pulled all of the triple AAA rated counties in Maryland, as well as Northern Virginia. And then added Howard County for both 22 and 23. And then I put the peer median, which includes everyone, just the Maryland County median, and then I pulled the national AAA county median as well. And you can see that positively the county remains above both the state and national medians for the AAA rated counties. You will see the peer median is a little bit higher, but that's being sort of skewed by some of these larger Fairfax and Montgomery County. So that's driving that median up. Full value per capita is just another metric to look at the strength of the local government's capacity to generate revenue, even beyond levying property taxes. Same peer group here, but you'll see positively the county's full value per capita remains above the state, nation, and peer medians for AAA rated counties. So very strong position. Same with median household income. So the higher the income level in the county, the greater the ability for a local government or the county to increase taxes or fees to generate additional revenue. So you'll see here again, as you know, the county has one of the highest median household incomes in the US, and that really shows here you are well above the peer, the Maryland AAA and the national AAA county medians. So overall, extremely strong in the economy factor of the rating assessment. So if we look at finances, as I talked about, fund balance and reserves is, one of the most critical rating factors. And so Fitch and S&P in particular have a similar way of approaching calculating, available reserves. They both look at the general fund balance. They look at committed, assigned, and unassigned fund balance, and they look at it as a percentage of general fund expenditures. S&P uses the current year. Fitch has proposed that they're going to use a 5-year available fund balance low, but that hasn't been fully approved since they haven't issued their formal methodology, but that's what they've proposed so far. But you can see here that the county's fund balance has increased 278% since 2019, and you're at a very strong 37.7% of general fund expenditures for available fund balance at the end of fiscal 23. So a very positive trend. And you can see when you look at available fund balance across the peer medians, the county maintains available fund balance above 11 of the 13 AAA rated peer counties. I think the only counties that are above are Calvert County and Charles County, but they are actually smaller counties than Howard. And so their higher fund balance helps to offset their size and, helps them maintain the AAA. That being said, looking at the rating considerations, you can see here that with the levels that the county currently holds in reserves, you come out at very strong and AAA under the reserve metrics, the finance metrics for both S&P and Fitch. Now, I mentioned at the beginning of the presentation that Moody's updated their methodology recently. And instead of just looking at the general fund like Fitch and S&P, they now look at all funds. So when they calculate reserves, they're looking at all governmental, all business activities, and all internal service funds. So this is a little bit different than what they used to do, but you can see here, I've just included an overview of the calculation. They're taking the same available fund balance method. They're looking at committed, assigned, and unassigned, except they're taking all governmental funds. And then they have a net current asset calculation that they do with business type activities and internal service funds. So they come out to an available fund balance ratio across all funds of 28.72%. And you can see here that at the 27% level, the county is coming out at the AA range on the financial performance section of Moody's methodology. You will see that at this level, the county does remain below the state, national, and peer medians. But you do have an available fund balance above 5 other AAA rated peers. So you're not the lowest by any means, but definitely from a Moody's calculation, not as strong as maybe the way that S&P and Fitch are calculating it. And I've added this slide just to sort of reiterate the importance of reserve levels in credit ratings. Over the last decade, both Baltimore County and Fairfax County have been put on negative outlook due to their reserves. When that negative outlook was put on, both Baltimore and Fairfax went back and revised their policies to increase their reserve policies. And by doing that and making an effort to fund reserves at a higher level, both of those negative outlooks ultimately came off. But I think I just wanted to make sure that, reserves are the primary and most important item that a rating analyst looks at. And, thinking about the available fund balance ratio as calculated by Moody's, we have had conversations with the county, about taking a look, at potentially looking at the reserve policy, and seeing how it compares and make sure that the county continues to remain in line with those other AAA peers. So in terms of debt and other long-term liabilities, you all have a debt to full value and then a debt service to revenue policy. And these are sort of standard policies across the industry for local governments. So just wanted to pull some medians for this. Debt to full value is a measure of debt capacity. It helps determine, can we borrow this? And while the county's debt to full value has declined, and I think you'll see this later in the debt affordability presentation, but this metric continues to remain above state and peer medians for AAA counties. And similar to debt service to revenues as well, this is a measure of debt affordability. It helps a local government determine, can I afford this? But while this has also been decreasing, which is very positive, when you look at the peers, it's still above the peer and county median, Maryland County median. And then finally, as I mentioned, in addition to debt, the rating agencies are looking at pension and OPEB. In terms of OPEB, the county consistently contributes above PAYGO, about 13.5 million above PAYGO in fiscal years 23 and 24. But when you actually look at the funded ratio, which is the planned fiduciary net position as a percentage of the total OPEB liability, and you compare that to the other AAA counties in Maryland, you can see that Howard is well below the peer median. So the peer median is 44.2% funded ratio as of fiscal 22, and the county is at 16.9. And so this might be something that the county wants to look at moving forward. Looking at the PAYGO amount and, potentially, increasing that to keep up with some of the other AAA peers. Sort of expanding on this, is the rating agencies have started to look at what's called a fixed cost ratio. So that looks at debt service, annual pension contributions, and annual OPEB contributions as a percentage of budget. And it really sort of gives an idea of how much these sort of fixed costs are taking up as the budget. So the higher the percentage that they represent, the lower the financial flexibility a local government has. The county is at 11.1%, which is well below sort of the rating agency mark of 20%. But it's just slightly above the AAA peer median, which is about 9.1%. So overall, remains below the benchmark, but just something to keep an eye on. And I think by keeping an eye on debt as well as funding for OPEB, that will help to sort of manage that fixed cost. So I think that was everything I had, but happy to take any questions from the group.
Thank you very much, Jennifer. This is really interesting and very helpful because the committee has been looking at debt and other issues there for years, and that's one of the actually undertake by the committee is recommending on debt level, among other things, and also the overall fiscal well-being of the county as well as policy, etc. And this is actually touching upon a lot of parts on that. I have one question I want to throw out, and then I think the rest of the committee, I'm sure there will be some questions. One is that from a credit rating agency viewpoint, because these are rating are indicator for investors, right? Because we have most of our bonds are 20-year bonds, with exception of Metro bond 30-year.
Yes.
So when they assess that, they're not only look at today, they are also look at your long-term flexibility trend, those kind of proactive measures, correct?
Yes, correct. And that's why they want to see the long-term, both operating and capital plans so they can get a sense of, what those metrics might look at as you move forward with what you're estimating.
Got it. Yeah, that's a good point because I remember there's one year people ask why credit rating matters because I think it's not only provide immediate savings when it comes to interest rate because different rated credit rating
Correct.
is different rate, but also it's kind of indicator about your overall financial health, comparatively speaking, because
Correct.
people have confidence in investment or other things in your government in your jurisdiction, right?
Yeah, no, because as I said, to get that triple A, you have to be comparable to other triple A's in all of those four factors: the economy, finances, management, and debt and other long-term liabilities. So they're looking at a holistic view, not only the historical trend of where you've been, but also where you are projected to go because a rating and an outlook is sort of a forward looking it's forward looking over the next like 18 months to 2 years is what they anticipate, and that can change obviously with each year, but when they assign a rating, they're taking a forward looking approach.
Got it. Thank you very much. Let's open up for questions. Anybody from the committee, if you have a question, please unmute yourself and just jump in. We're a little bit informal here.
This is Richard Clinch. What would you say are the major risk factors for maintaining the county's AAA rating?
I would say that the fund balance and making sure that that stays strong and in line with other AAA peers, that would be first and foremost. And then I think, as I mentioned, OPEB following thereafter. And I think that those two would be my main sort of takeaways as to what to focus on going forward to maintain the AAA. I think, while you can focus on those, I think everything else sort of still needs to be maintained. Because as I said, it's a holistic view across all four of those factors. Did that answer your question, Richard? Sorry.
No, that did. I just wanted to make sure there were a couple of things I wrote down. So that was perfect. Thank you so much.
Okay. Yep, not a problem.
And just for the audience, that OPEB is post retirement post employment.
Other post-employment benefit.
Benefits. Yep.
Thank you, Ravi. Yeah, and that speaks to some of the long-term forward-looking assessment we talked about earlier because these are long-term liabilities. That's why today we can pay off what's needed right away, but eventually the liability are there and those keep growing. So again, we have been trying to try to help address those long-term liability, but it's clearly there's still more to do. Thank you. All right, thank you so much.
Thank you.
And this is greatly helpful, and thank you for helping us. By the way, Jen and Joe from Devon Point recently just helped us in our presentations to credit rating agencies. So it's very hot and fresh. So hopefully we'll get some good news regarding maintaining AAA pretty soon. Thank you.
Yep, not a problem. Thanks so much.
Thank you. Rafi, would you like to perfect time for you to talk about debt affordability? Do you want to share your screen?
My slides, or do you want me to share my?
Yeah, would you like to share from your side?
Sure. Okay. All right. Can everybody see my slides now?
Yes.
Uh,
Make it a little bigger. Okay, perfect. Thank you.
All right. Okay. Well, good afternoon, everyone. I'm Rafiu Hila, Director of Finance for the county. I do have my team here with me, Angela Price, and Deputy Director of Finance, and John Vu, our Debt and Cash Bureau Chief. Well, today, as normally, we cover everything on including credit rating, but that has been covered by Davipur Jennifer Jackson. So we're very happy and fortunate to have her. So I will skip most of the slides as it relates to credit rating. We will be covering our current debt management policy, projections, and of course the bond authorization process. So first, we always like to share why the AAA rating is very important to us. As you know, we've had this now for the past 26 consecutive years. And as we've heard from Jen, this is a big deal to be a AAA because we can borrow money at the lowest rate. And then, of course, the second bullet here is the county executive transition team issued a report making these a top priority, and which is in line with what we in finance strongly believe in. This should be a priority for every county to borrow money, especially when you are spending public funds. You should try and borrow at the lowest cost so you can spend more money for other needed capital projects. So, of course, we've covered rainy day fund, which is another major aspect. So, and we've beefed that up now by adding the policy reserve, as Jen showed us earlier. And just to highlight, for a $150 million bond sale, the county estimates that the interest savings due to AAA rating is over $1 million over the 20-year life of the bond. And of course, after you issue these bonds for a certain period, the county equally has the ability to, if the rates go down, to try and get some refunding so we can save more money with our current bonds. So I'm going to skip all the credit rating slides. I don't think they're needed. We've talked about fund balance, rainy day, and slide 7 is our current debt affordability measure. This is critical, as you can see from 2009 through this last year. It's been trending downwards, and that has been critical. This is our standing geo debt compared to our accessible base. So as a percentage of accessible base, our policy requires us to have not to exceed 4.8%. And we are very happy, and I think that reflected in Jen's slides as well. We are way under 3%, so we still have the ability, but the goal is to be under 2% if it's possible. And the next slide will show that. So our projection for this current year through 2030, you can see the rate is going to drop from 1.97% to approximately 1.43%. So we're very happy, and of course, the assumption here is that we are issuing $90 million in debt beginning this current year at a 4.5% interest rate, plus the $75 million WIFIA loan, which we hope to start drawing in FY 2026. Right. Of course, our second measure is a debt measured against the population on a per capita basis. Our population has been increasing, and we are approximately, last year was 335,411 folks in Howard County. Our standing debt was $1.2 billion. So that gives us a debt per capita of $3,766. So, and our goal is to try and, as we bring that debt ratio down, this will equally drop slightly. So when you compare these as in terms of per capita income as a ratio of debt as a ratio of per capita income, you see we are way below our policy measure, or what the rating agencies initially used at 10%. But this measure is no longer being considered by the credit rating agencies. But we still use it. It gives us kind of a framework of what we should be looking at. And we've always been below 5%. So the goal is to make sure that we watch this regularly, because these are comparing the debt per capita to our population. So we need to make sure that that is as low as possible. So current debt affordability measure, and I think this was a slide that Jen showed. We are very, I know, last year, a few years ago, we talked about the reason that we exceeded our policy threshold of 10%. That was because we issued a $75 million bond for the courthouse, the P3 courthouse. And we did plan that this would definitely go down and be below 10%. So we are very happy that this is now below the 10% threshold. But if you compare this to what Jen presented at 11.1%, the reason there's a minor discrepancy there is that we do add into our computation the two funds that help pay for the debt service, which is the fire fund and the environmental service fund. So those two bring this the ratio to the 9.75, which is not factored into the presentation that you got from Jen of Davenport. So we are trending downwards as of June 30th last year. So of course, we always try to make our projections for future years. So if you look from this current year through 2033, that rate is going to drop. It's going to go up for this year to 9.99, but under 10. And in 2033, that rate is going to drop to 8.58%. So of course, the assumption we're using is 4.5%, and I think that is key. We hope not to issue debt, geo bonds at 5.4%. We always hope to be under that, but for computation, in case that rate push that close, that our estimates are still very valid, because we are very conservative in our approach in our projections.
So, Rafael, if you don't mind, I want to make a quick comment on this slide.
Sure.
This is a slide, obviously, we have been focusing on for years, and over the past several years, this is the first time actually I saw a very, I'm very pleased to see that the percentage actually, none of this is above 10%. So I'm very happy, and because as you just mentioned there, we have a policy, internal policy of debt service not exceeding 10%, but in the last several years there, the projection has been over that because historical debt already carried and other reasons there. So we have been, again, I want to credit a lot of people there, including the committee, for try to make sure we execute debt management and fiscal discipline. So for the last several years, the county has been holding geo bond at around 75 million every year authorized there. At the same time, try to use alternative financing, including lower interest refill loan, and including using designated revenues from other sources there, including use cash pay-go as one-time money to continue to support the needed capital project, but holding the geo bond at more manageable level. And year after year, it finally pay off. I just feel personally very happy to see finally the projection are coming down to close to where we need to be. And obviously last couple of years on the revenue side, despite the pandemic, we actually have been seeing more than typical level of growth on revenue side, that also help contribute to that. But overall, I think that's very positive. I just want to make a quick comment to everybody who has been participating and kind of make this happen. Thank you, Rafi. Sorry for interruption.
No, thank you. I think that is very valid because we've been making that commitment here, and now at least the committee can see what we're doing here in the committee and what we are doing in finance, trying to keep watch on these, and with working with budget, that we are seeing the fruit of all the hard work. So thank you. So bond authorization and issuance process, and I think this has been one area that the committee is very interested in because there's always this kind of difficult to explain most times, but when bonds are authorized, doesn't mean that they are issued immediately. So, but of course, bonds are authorized in conjunction with our capital budget process, which normally happens in May, and then of course is now available starting July 1. That is when the project starts. But of course, capital projects takes more than a year, more than 12 months to complete. And at times it takes even longer. But of course, when we bonds are authorized, they are in effect for 4 years. And if those bonds are not been issued, we reauthorize them through the capital budget process as well. Of course, we do the obligate bonds if they are no longer needed, and all of that stuff happens. But we do a lot just to work with everybody, with all our project managers, to make sure that we do our due diligence before those reauthorization and the obligations occur. But of course, the way we average it in our projection is that we anticipate that for 4 years that we're going to spend, we're going to issue 20% per year over the 4-year life, and of course, is a true up. But that's kind of our estimates. But at times, the spending increases in 1 year and then it drops in another year. But then we factor all of that as we spend money into our projections the following year. So, but one of the things that the county will do is that we don't issue bonds before the projects are completed or before the projects begin. We issue bonds to reimburse ourselves or to take down our line of credit. So the county has a line of credit, and so that's how we pay for most of these capital projects. So this, when we issue bonds, we then take down this facility, and then of course the process starts again. So on this slide, we have the authorized but unissued bonds. As you can see, this is from fiscal year 2020 through 2024, and we've equally made some estimates for 2025. So you can see there's a lot, but these are all the funding sources for all the various types of bonds that we anticipate. So I think the last one is the general obligation bond, and which you can see is the largest at for FY24 is at $362 million, approximately 363, and for 2025 the estimate is 306. So we are assuming that yes, so they are going to be issued, but of course we add whatever the new authorization is to this as well. And on this slide here, I think this is probably closer to the end now. This is probably our last slide. Is that we try to provide an average of issued to authorized bonds. So you can see the average is about authorized about 106 annually, and then we issue approximately just over $99 million. So in all, we can say we are issuing over 90% on average, but capital projects do take a while, and you see at times we issue bonds more than the authorized for that year. That's because as the money gets spent, the previous authorization gets issued. So I think that is that's really the end of our slides, and I think I've introduced both Angie and John in the beginning. We are available to answer any questions.
Thank you, Rafi and the team. Any questions from the committee? Okay, if nothing, you know where to find Rafi. he's one of the advisors of this committee. And thank you very much, Rafi, for putting this together with your team.
Welcome.
Okay, so next one will be backed budget. So let me share the screen on the budget presentation. All right, can you all see it?
Yes.
Okay, thank you. Thank you. All right, so we'll start with preliminary projection of revenues there for fiscal 25. For folks familiar with the county's general fund budget, which is used to support most of the services of both the county and our education entities there, 92% of the revenues coming from property tax and income tax. This percentage sometimes change a little bit over the years, but in general, it's kind of hovering around 90%. Then the rest of them are relatively small. That's like local taxes. There's fees and charges, permits, investment income, and some interfund transfers, etc. But primarily property tax and income tax. Now, the good news is that our number one tax, property tax, are projected to perform well in FY25. So it's FY25, not F25. But the reassessment growth we just got from the state is very strong. And as you all know, 1/3 of each county's real property get reassessed. And the value is compared to 3 years ago. And then the increase will get phased in the next 3 years. So the most recent area get reassessed is towards east side of the county, and the average facing value will be a 6.8% growth per year. But again, in Maryland, there is a smoothing method that the state asks each county to have a homestead credit. So in Howard County, that's capped at 5% for owner-occupied property. So in other words, if your own property say, okay, you go with average of 6.8%, but your tax bill is going to grow by no more than 5% a year. That's for protection of the taxpayer, but in practice, it also provides some smoothing factor for effect on the county's property tax there. The overall assessment base for the county combined different areas that's in different stage of phasing and plus new constructions there is projected 4.8%, and that's coming from SDAT number and factoring the homestead there. And that's historically strong. If you look at the table down in this page there, it shows 15 years of history of assessable base. What's in blue is the gross assessable base change. The one in red is net base after factoring the homestead tax credit there. So a couple points to make. One is that the average growth in this 15-year is around 2%. To be accurate, is 2.2%. So in a long-term viewpoint, the property assessment growth is really just a little more than 2%. The most recent years, however, we have been doing better than that. The average is 3 point something, and then in the next few years, we might be even better, which I will show in a few minutes there. So this is the reassessment triennial change in full value before the 3-year phasing. That's why you see some of the big numbers there. So for Howard County, area 3 was reassessed at 20.5%. And once you do a phasing, that's on average of 6.8% there. So that's extremely good, and we are happy about that. It also means the next couple of years, that group will continue to generate some relatively historically strong level of growth there. A couple points to point it out is that while that continued to be strong if you look at the comparison to the state average, we actually have been lagging behind the state average for a couple years now. The other point is that this is a blended growth between residential and commercial property, and commercial property base also show a positive growth, but at a much lower rate, as about 8.7%, which is also lower than state average in this period. So in general, we see continued strength there, but compared to our peers, we actually are just losing a little bit momentum there. It's interesting. Other day, I think I had a conversation with the budget director from the school system there, talk about state aid change to the school system actually end up being higher than originally anticipated, but not necessarily driven by a great reason. Part of that is because our per pupil or the county's per capita wealth is actually not as good as original thought there. So as a result, we'll get a little more state aid on that. So in general, I just want us to be mindful about the long-term trend. We are continuing to be solid, but we are seeing some slowdown of the momentum in a long-term viewpoint compared to peers there. So factors impacting property tax there, we just talk about the relatively strong housing market in recent years that actually has been a main driver of the assessments there. And we are also thankful to the state's triennial assessment, which means that we are not going to see double-digit growth in our tax in any given year because of the cap. But if the housing market has a downturn, because it's mixed with prior year facing, we're also not likely to see a very dramatic impact on our tax base. So in other words, we are seeing less volatile changes here. It also means that in the next couple of years, we might be able to see still above average level of growth for our property tax, which is definitely good news. We are going to have to realize there are some foregone revenues from tax credit, there's homestead. I know there was a continued and more tax credit given to aging in place credit and also other credit there. So that will be used to offset at least partially of some of the growth. But nevertheless, the property tax should be relatively strong. There are obviously risks there and or uncertainties there. Again, the mortgage rate is very big unknown at this point. It's still very high, and the housing market is not moving in terms of transaction currently. So if that's continue and housing price, whether they will be able to hold at they are now, or at some point might see some changes, or it's very hard to predict at this point, and affordability is an issue. That also impact how much more the price increase room are available for those residential properties there. And commercial base, that's another thing. We do see some weakening in certain parts of the economy there. And in fact, the personal property tax, which is really on the equipment of the business there, that actually has seen a downturn compared to 2 years ago. And that's not only for us, but also for some other counties as well. So that's also impact overall property tax, although there are a relatively small portion compared to real property tax. And new construction is another factor. I think you saw earlier presentations there between DPZ and others there talk about the permits issued for new construction has been dropping in the last couple of years. That actually will be indicator regarding the immediate future new construction down the road. So that's going to have some impact. And unfortunately, we do have the local by design, the updating of the development plan for the county and general plan that hopefully can help mitigate some of the slowdown. It will still be slowdown for the new construction, but not that dramatic, hopefully in the next 10 years or 20 years on that. But in near future, I think we're likely to see a slowdown new construction. Now, income tax is second highest tax of the county. This one is very interesting because it's very volatile, not like property tax, which is relatively stable. Our year-to-date collection, and as of the beginning of February, was actually showing a significant decrease compared to the same period of last year. It's a drop of $37 million there. It is partially driven by one-time factors there. If you look at the the history in last few years here, the county's income tax has been pretty much in roller coaster there. And before the pandemic, the average is low more than 3%, 3.4%. That's actually pretty close to personal income growth. So for in the long-term trend, the county's income tax growth is close to personal income growth as it should be. But when it comes to individual years, things could be much more complex because there are a lot of one-time or temporary factors that play a role. For example, FY21, at that point, we see a double-digit increase in income tax, largely thanks to federal stimulus, and also there's kind of crazy performance at that point for stocks market and housing. So the capital gains was high. So these are one-time factors. So at that point, if you remember our conversation back to that point, was talk about we are worried about the other shoe will come down because that's not sustainable. We're actually expecting some corrective actions to happen. And it didn't happen the following year because the high inflation, and that transferred some wage growth there. If not for that factor, I think we'll see a much weaker performance that year. And then 23 actuals coming, which really shocked us there. It's 9.9% growth. It's almost doubling the actual personal income growth there. Then after communication with state, it looks like there are some combination between behavior change, consumer behavior change, and distribution formula, and the actual timing because of lagging impact on that. So as a result, 23 number is clearly inflated there. The reconciliation distribution is much lower than usual because it's kind of more recognized upfront for those income tax there. So as a result, we see a significant drop or corrective action currently happening there. I don't think for the rest of 24, we'll continue to see it as significant downturn for the rest of the year. We do see some softening there, but fortunately, 24 budget, we kind of already factored in the assumption there because we don't think the 23 number was sustainable anyway, or that number, it doesn't look like reflect the true base. So we already budget adequately. So as a result, I think at this point, we're looking at 24 actual very close to original budget number, not likely to see a huge shortfall in the mid-year. So that's a good news. But on the other hand, it does kind of meet our previous expectation that some corrective action will happen. It does occur now. So after that, I think things, hopefully, I guess I shouldn't say I think, I hope things will go back to normal once the corrective action goes through this year. And FY25 and 26, we are hoping that kind of go back to the normal, which is close to probably 4% of each growth there. You hear Dr. Clinch made a presentation about a week ago about the county's personal income. So the left side, the bar represent Howard County and Maryland actual performance of personal income. The blue bar is Howard County, and to the right is estimated personal income growth in the next few years. There, following a very high spike in 21, clearly driven by one-time temporary factors, it dropped to very moderate growth of 2.7% in calendar year 2022. It appears that it's in the process of recovery, and based on Dr. Clinch and the team's projection, we will likely still see around 4.3% growth on average in the next several years on that. So that compared to historical level, it's a little bit higher than historical level, because historically I think it's like a 3.5 to 4 point something ish on that, but remains pretty strong there. But when it comes to individual years, as we said, sometimes you see pretty weird swing between different years there. I think EDA earlier also, Jennifer Jones, CEO, also presented this chart. It was showing that the county's residential employment continue to grow or recover. It, however, as we all know, still hasn't reached the pre-pandemic level, but nevertheless have been maintaining a solid growth each year. So income tax and property tax, as we just mentioned, that make up more than 90% of the total general fund revenues. So how about other revenues here? Other key revenues, including some development-related tax and fees, such as recordation taxes, building permits, reviews, etc. Those taxes or fees in general have been experiencing double-digit decreases, using recordation tax as an example, and also transfer tax, which is used for CIP. Those experienced, I think, more than 30% drop in fiscal 23, and current fiscal year-to-date continued the trend of like roughly 25% growth year-to-date. Again, we already budget for that, so it's not going to be too much different from what's budgeted there. It just continued that downward trend, unfortunately. But as market conditions change, we're hoping that with the Fed make some policy changes here, we're hoping the mortgage rate will come down a little bit more down the road, and as a result, hopefully some of the transactions become more active from the historical low level. And as a result, some of the fees and permits and taxes can be better. So we're building some recovery in FY25 preliminary projection from the bottom. State aid is very limited in the county's overall general fund for Howard County, not for some other counties there. We generally see very flat to very moderate growth in state aid to the county. The only exception is highway user revenues. The state legislators a couple years ago made a determination that the county should be restoring some of the highway user revenue, which was cut by the state many years ago. So after some debate at the state, the governor's proposal tentatively kept that, but there are some indication we heard is that it's a one-time deal, meaning that after FY25, numbers may go back 2 years ago to 23 level. So that's going to drop by about $2 million from that level. So, but there's still a lot of uncertainties about what's going to happen in that place in the next few years on that. But still, nevertheless, we see some increase this year, which is really good to know. State aid to education entities there. These are the direct distribution to our school system, community college, and library, not including the county's own general fund budget. We see in general relatively moderate growth to school system and library this year. I think they all talked about in their own presentations there earlier, and also the community college actually received a reduction because the formula is linked to the enrollment there. So that caused some difficulty to their side. So that's just the general ideas about the most critical revenues here. So when we combine all these together, what we are looking at this point is about 4.5% growth from 24 budget. What does that mean? Is that number one, it is coming down from last 2 years. Last 2 years, actually, we have been seeing more than 6% growth for all those reasons we talked about early. That's non-sustainable, and we share with this committee before on that. So this is coming down from that. It's still not coming down all the way to historical average. Historical average is 3.some%. So this is still better, largely thanks to property tax and to some extent income tax as well. So in this projection, we're assuming property tax close to 5% from the budget level, the income tax about 4.2%, very much in line with the projected long-term personal income level, and some other local taxes to see some recovery from after multiple months of decrease because of housing market. And state share tax reflect the change for the highway user revenue. Other ones just see some moderate changes there. And then transfer tax, etc. These are just the technical changes there. Any one-time elements was removed from prior year. So with that, we're looking at close to $62 million or 4.5% growth on that. So with that, the next slide was showing a multi-year projection. The overall projected level for the future 5 years beyond FY25 average 3.3%. If you recall last year's projection, that's also look at close to 3.3%. So the overall trend average, there are not too much difference. However, the allocation between the years are different now. So what's happened is, as we just mentioned, the property tax, because assessable base has been strong for a while, then these are going to kind of continue to go through the pipeline, at least impact some part of the property that continue the strength there, which will be mitigated with other new property get reassessment in next couple years. So in general, we're seeing property tax maintain relatively strong growth for a couple years before it goes back to historical average. As we talked earlier, the average historical average is about 2%, but in next few years, we are confident we will have 3.5 to 4.5% for a couple years. Income tax in the long-term trend, we're using roughly 4%, assuming that we will be very close to personal income growth there, and that the other local tax permits there, we kind of look at historical trend and building that into the multi-year projection there. So in general, we are looking at relatively good performance in next few years, and then go back to historical average of a little more than 3% or around 3%. So I have to point it out that we really haven't factoring any potential shocks from economy, natural disaster, geopolitical risk, or any other unknowns such as stocks market meltdown, housing market plunge, because these things are unpredictable. Yes, there will be economic cycles, so some years might be better, some years may be worse than what we're seeing here. But for now, we're just try to use the trend as a guideline to look at overall performance in foreseeable future. And one thing to keep in mind is when we look at the multi-year projection, it's really more important to look at the overall direction or the trend rather than the technical details on individual years on that, because there are so many other factors that play a role that we're not aware of today that's going to change it. There are some long-term concerns that the committee is relatively familiar with that will continue to play a role. You hear the previous presenters from our economists, from others share their reading of the economy that include the demographic trends, the economic development trends, and the housing trend, etc. So folks talked about the new development has been slowing down and looks like will continue. And we also look at the housing affordability level that could mitigate future price increase or assessment increase potential for the housing portfolio there, and the aging population and net income loss from folks moving into the county and moving out of county. All those have an implication on the future revenue growth capacity and also the service needs there. And in general, these are pointed at solid but likely slow down pattern when we look at beyond 1 year or two. So how does that, what does that mean for FY25 budget? So we just talked about the revenue side. We are looking at very solid above average growth of revenue there. As usual, that compared to the expenditure request collectively is not enough. At this point, we're looking at about 6.65 million gap based on information we received so far. You already heard the superintendent, acting superintendent's presentation together with the team from the school side. The request is about 40.7 million recurring funding from local government. And by the way, that has been updated from prior requests because the maintenance effort number dropped even lower now due to enrollment decrease for the students there. Community college and library combined are requesting 4.7 million increase from the county, and obviously every year we have to pay debt service there, and we have a plan to continue to increase the OPEB contribution. Those combined together are estimated about 9 million increase a year, and all other agencies, including our funding to different nonprofits, etc., that's in aggregate about 73 million. So in general, we are still looking at pretty significant gap there, which we have been working very diligently with all the stakeholders, internal and external, try to bring things together, because at the end of the day, we have to deliver a responsible and a balanced budget, not exceeding the revenues available. There are multiple critical needs for FY25 that we have to address and balance at the same time, which cause the challenge there. Obviously, we always have to do our best to support education needs there from the 3 education entities there. We understand the critical needs there. So that's a part we want to always do our best there. There are also a lot of other service needs there for across the community for different age groups. There are different communities there and a variety of needs there, and at the same time have to fulfill the non-discretionary obligation, both for short-term and to address long-term liabilities there. There's also, the county is conducting or having a consultant conducting what's called a compensation and classification study. That has not been done for 25 years, so kind of overdue already. And they're still in working progress, but looks like there's already identified a lot of places that really need some adjustment there. They are not the narratives, the duties, the scale, and the setup doesn't really either reflect the market trend or other peer counties or cities layout there. So that's also would need to be supported to the extent possible. And from what I hear, there will be a lots of needs there, and some actually adjustment might need pretty sizable investment there. And lastly, but not leastly, is that the COVID funding we have been receiving from the federal government and state government has been largely exhausted, and some of the needs do not completely go away. So we have to transition and try to maintain, continue some support. Sometimes we have to stop, sometimes we have to scale back. But in this post-COVID grants era, we have to maintain our support, our community to the business, to the nonprofits, which we are fortunate to have to provide those needed service and some of the programs there. So all these are challenges there. We have to make it work and work with everybody to develop some solution collaboratively. The multi-year projection, again, folks are probably very familiar with the graph now. We make changes each year based on updated information, but the trend is very similar. We received the request from all those entities from both internal agency and other government entities there. The expenditure needs always exceed our revenue growth there, and the cumulative deficit to close, if we don't take actions every year, then it's going to increase to 1 billion by FY 2030, and the annual gap is somewhere between 65 to 292 million per year. Now I have to say that this gap actually a little bit less than last year. Last year at this point, the cumulative deficit in next 6 years was actually 1.4 billion, I believe. So I think we do see a little bit slowdown in the expenditure requests and a little bit better on the revenue side, which help lower the annual gap to some extent, although what's remaining is still pretty daunting. So we'll need continued work, collaboration among all the stakeholders there. On the capital side, I would say it's no less challenging. It's actually have a lot of needs there as well. We actually probably talked about a little bit at the beginning of SAAC meetings back in January. We do now have the planning board version of GEO and other requests from different entities there. At this point, just using GEO bond related project as an example, we received a request of between 165 to 180 million a year, and you already know how much we got approved every year. It's hovering around 75 million in order to bring down our long-term debt indicator to the manageable level on that. So there's clearly a huge gap around 100 million a year. So for anybody in my position, try to work with anyone to try to cut back 100 million every year or find funding solution for that. It's truly a daunting task on that there. And this hasn't even factored in some other needs there that's also run out capacity. For example, there are certain projects there that's historically funded through designated revenues, such as the watershed fees. I mean, you heard from one of the presenters talked a few weeks ago about stormwater ponds, and those were used to be supported as designated revenues. But if those get exhausted, and then the issue is that if there's no adjustment to the fee structure, then it has to be either added on top of this gap for GEO or PAYGO to deal with, or it has to endure pretty significant cutback for those projects as well. Similarly, transfer tax, there are some projects there are not going to get the funding as original planned because the market performance we have talked earlier that we have seen double-digit decrease 2 years in a row now. So as a result, that's impact their capacity. So then the issue is that do we switch that to general fund funding as well, or we just have to size back our projects there. So anyway, there are plenty of work for us to address. We're going to work very hard in the next few months to deliver a balanced, but also balance the budget, but also hopefully still able to support key needs to some extent. Now, what are some of the strategies we have been looking into or implementing consistently? One is the fund reserve policy. Our financial advisor talked earlier, and I think Rafael, our finance director, also mentioned that about our reserve, which is clearly very critical because in the time there's continued uncertainty. With reserve give you flexibility if there are unforeseen situation that you want to avoid cutback service dramatically, or maintain the basic needs there. So the county years ago set aside a policy reserve, which is 3% on top of rainy day fund. So we currently have 10% set aside, which has been protecting us there. As the financial advisor mentioned, that we are actually in the right range currently compared to other AAA counties there. But if you hear her, she was basically to the extent possible strengthen that, because at some point, if the fund balance started to drop, then that could be a red flag. Sounds like for rating agencies' viewpoint, but also for us, because that means we have much less flexibility to deal with and risk or uncertainties there. The other things we have been trying our best to include more innovative solutions there and take proactive approaches there, meaning that we try to look beyond 1 year or two and try to make sure that the policy or practice today will benefit long term. For example, we have been seeking for alternative financing for CIP, also the pension plan. We have been lowering discount rate in that last couple years there, and we also try to look at different scenarios, so we always get prepared rather than lock into a one scenario and without flexibility there. And importantly, we have been doing best to engage the public and the key stakeholders on critical decisions there. One thing that the committee in the past have been included in the report is recommendation to work with all the stakeholders to develop a sustainable financial plan, because we have been showing multi-year projections with a gap. So the committee wanted the county to look into collaboratively develop a financial plan. But that's really a great suggestion, but you really need all the stakeholders willing to sit down together to do that. And as one I guess one step positively towards that is that executive order already established a blueprint work group in the last several months, that the group has been trying to pulling different stakeholders from state, local, county, and legislative branch, and even nonprofits together try to look into the state mandate, some of the education needs, and discuss the solutions jointly. That's very positive. We had some meetings with the new management leadership from the school side, and that's also sounds very open to looking to working together to look at the long-term sustainable plan. That's also very encouraging. So hopefully we'll continue that kind of candid but collaborative dialogue there. And general plan update, as you heard from our expert from our DPZ, that process very transparent, engage a lot of community folks there through numerous meetings and comments received. And that plan was very hopeful to help the county's development, especially redevelopment in the next 2 decades. And that hopefully can free up some of the new construction or assessment growth opportunities there. So with that, I'm going to conclude my presentation. Before we go to reviewing next couple of meetings here, I want to pause and see if there are any questions. Okay, so if anyone has questions, please feel free to unmute yourself and we can discuss. Or if you want time to digest that, we can use next a couple meetings to talk about when we talk about recommendations. Either way works. Okay, sounds like people need some time to digest, which is fine. So let me show it back. So maybe we can talk about next few meetings there. Starting from next week, we have 3 weeks for the committee to discuss and decide on key recommendations to include in the report. So Steve, unfortunately, I think he's not available today. He was actually in all previous meetings there. Steve appointed my vice chair, is going to chair future meetings here. And he's going to kind of talk to some of the key points there and ask for advice regarding what are the things that has the consensus from the committee to be included in the report. That typically a few different items there. The report is supposed to provide projected revenues for FY25 as a ceiling, and also a geodebt obligation or authorization ceiling, and also any major a multi-year projection information, as well as any revenue, expenditure, or policy side you feel are important to maintain or enhance the county's fiscal well-being, either for FY25 or for future long-term sustainability. So anything can be discussed, frankly speaking. And typically, because we have a pretty big group, after the discussion and people have offered major discussion about what are some of the key recommendations to include, and usually he's going to pull a few or several members there to kind of work on a draft report on that, and then bring back to the full committee for discussion, edits, and then final votes. So that's the general process. And just a reminder, next week we actually have 2 meetings blocked. One is on Monday, one is on Wednesday, just to ensure everybody has a chance to participate in the recommendation discussion, since that's important for the whole committee and for the final report. And then we have 1 week of no full committee meetings here for some folks to working on the report, draft the report. Then the last week of February, there will be the voting and review of the report. So that's a general plan. With that, I'm going to conclude the meeting. Again, does anybody have questions? If not, just want to thank everyone for participation. And also thanks to all the speakers today for sharing very important information. These are all critical to the final report. So again, thanks everybody. And also I want to take opportunity to thank all IT folks and also interpreter for and Paul from my own office for make this happen smoothly every time. Thank you all. I will see you next Monday, hopefully. Thanks.